Marcel, and for today's topic is all about what is the income approach. So I'm going to discuss here the underlying ideas of the income strategy and how it is applied to estimating the value of an asset. As we all know, the income approach is a popular technique in real estate and finance in order to determine the worth of an asset that generates the income. It also analyzes such data to determine the asset's current value while concentrating on its potential for future revenue. The method is especially necessary for valuing assets, companies, and investment prospects. So I'm going to use some examples from the actual world and computations to demonstrate how the revenue strategy is being used. Approach. So what is income approach? Income approach is sometimes referred as an income capitalization approach, and it is also a type of real estate appraisal method and allows investors to estimate the value of a property based on the income where the property generates. In the commercial real estate, capitalization rate is also known as a cap rate and is used to describe a projected rate of return on an investment property. So the next one is how the income approach works. Okay. The income approach is typically used for income-producing properties and is one of the three popular approaches to appraising real estate. So, okay. When using the income approach for purchasing a rental property, an investor may also consider the amount of income generated and the other factors to determine how much the property may sell or under current market conditions. So when deciding whether to issue a mortgage to an investor, a lender will of course want first to know the possible risk of payback in order to assess if the investor may benefit from the rental property. For appraising a real estate, the income approach is considered the most involved and difficult. When adapting the income technique to buy a rental property, an investor must also take the property's condition, and it is also important to note that the future revenues could be significantly reduced by potential cost repairs. So the next is example of the income approach. Okay. So when valuing a four-unit apartment building in a specific country, the investor looks at the recent selling prices of similar properties in the same country. With the income approach, an investor should of course use market sales of comparable for choosing a capitalization rate. So the second example is a property with a net operating income of 700,000 and a chosen capitalization rate of 8% is worth 8.75 million. So the investor here might divide the rental properties in OI by the capitalization rate after determining. So the next one is what is net operating income. Okay, NOI is a calculation used to analyze the profitability of income generating real estate investment. So NOI is the sum of all property revenues less all running costs that are deemed to be reasonably reasonable. So NOI is a before tax figure appearing on a property's income and cash flow statement that excludes principal and interest payments on loans, capital expenditures, depreciation, and amortization. Okay, so let us proceed to understanding the net operating income. Okay, net operating income is a valuation method used by real estate professionals to determine the precise value of their income producing properties. Okay, NOI helps those real estate investors to determine the capitalization rate, which in returns helps them also to calculate a property's value, then allowing them to compare different properties that they may considering whether it is buying or selling. Okay, so let us proceed now to how to calculate net operating income. Okay, to calculate net operating income, subtract operating expenses from the revenue generated by a property. So this is now the formula. Net operating income is equals to RR, or the real estate revenue, and the OE, or the operating expenses. So we're going to to subtract the revenue from the revenue and then the operating expenses. So the net operating income in this example would be the total of revenue, that is 26,000 minus the operating expenses, which is 10,000. It is equal to 16,000. So let us proceed to the next, the components of NOI. So based on the formula, the primary components of NOI are total revenues and total operating expenses. So the operating expenses represents the total costs associated with the rental property. Not only the rent, but also all the rental income from a real property that is included in overall revenue. This may also include the additional revenues generated by a parking or storage space rentals, as well as vending machines and laundry services in a certain buildings. It also covers the cost of taxes, insurance, management charges, and utilities that are not covered by the tenants, in addition to maintenance and repairs. So let us proceed to the next, which is net operating income versus gross operating income. Okay, NOI is different from the gross operating income in real estate. Represents the total potential income from a property minus any lost income due to vacancies. Okay, the gross operating income, including the operational cost, is the net operating profit. Net operating income is useful in estimating the potential income from an investment property. So the next one is NOI and cap rate. So net operating income is used to calculate the capitalization rate, a measure of the profitability of the investment property in relation to the total cost. The cap rate is calculated by dividing the NOI by the total cost of a property. So capitalization rate represents the investment returns from the different properties. Okay. Okay, so the income approach is a method of valuation applied to value an asset, for example, a business or investment real estate, which takes into consideration its earning potential. It is generally used as a valuation tool in the area of real estate, funding the business valuations. The income approach takes account of the principle that in order to determine the value of an asset, a current valuation of its expected future earnings is used. So the approach is based on the analysis of cash flows from asset and use of a cap or discount rate in order to determine its current value. Okay. It is a highly useful framework for determining an asset market value in relation to its potential of generating revenue. In assessing the attractiveness and value of an asset, investor and valuation professionals will be able to analyze the future cash flows and apply